Yo, welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today got another portfolio update for you guys, the weekly portfolio update series, and there's quite a bit to talk about, so I'm going to get straight into it. We're going to talk about the good, the bad, and the ugly within my portfolio. We're going to talk about some market news and some market potential positivity, so you guys can actually be aware of certain things that may have a positive impact on your current portfolios or potential opportunities in the future. We're going to talk about India, we're going to talk about emerging markets, we're going to talk about PPI and banking stocks, and also going to talk about 8 pending stocks that I'm going to bring into my portfolio, stocks, ETFs and REITs, which I'm going to bring and include into my portfolio. So if you want to know more, please like, please comment, please subscribe. On a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, let me say a big thank you. I said thank you yesterday. There's different audience in this video. I want to say thank you again today for those of you that have helped the channel hit to 1,500 subscribers. I think it's a big milestone personally, and I'm really grateful that you guys are following the progress, but you guys are also benefiting from it, contributing, giving support, messaging, asking questions, and just generally engaging with the channel and what we're trying to achieve, which I think is a great look. And so I'm very grateful for hitting 1,500 subscribers, so thank you very much. But first, let's get into my portfolio. So as you would probably see from the thumbnail, I'm up about just shy of £100 from last week. I haven't actually invested. Typically this is my round of investing week, but I haven't actually invested yet this week. So the £100 is just purely organic within the portfolio, and that shows a slight uptrend within the market this week, which is obviously great news. Now primarily this is actually due to the trade war. So there's not been a resolution. For those of you thinking, has it all been resolved? Has Trump's account been hacked? No, none of that has happened. What has basically happened is that obviously the first set of tariffs are due to come this weekend or next week, and Beijing said that they wouldn't react to Trump's demands. They're trying to de-escalate it, so they're not looking to retaliate basically at the moment. And so obviously, because China is actually trying to de-escalate the situation, that's actually had a positive impact on a lot of the markets. We've seen the FTSE 100 rise 1%, we've seen the Dow rise 1.15%, the Nasdaq rise 1.45%, but we've also seen the S&P 500 rise 1.2%. And as you can see on this graph here, there's been a little bit of an uplift. As you can see, if I look at the 7-day chart in the S&P 500, and obviously, there's no data for the 1-day chart for some reason, but in the 7-day chart, you can kind of see that there's been this uplift, trended curve upwards. That's happened on all of the major indices, and it's primarily that there's been a positive reaction to China playing the moral higher ground and saying that not going to react, because obviously this is just going to have a negative impact on everybody. So that is really good news, and hopefully this will continue into the future, into next week and beyond. Obviously there does need to be a resolution of some kind. It might be that they're just not reacting at the moment, but they've got some catastrophic plans in the next couple of weeks. Who knows what the future will hold, but obviously you guys might have seen an uplift in some of your portfolios, and if you're wondering why, this could be one of the potential reasons why there's been a little bit of an uplift week on week. So for me, it's contributed to a week on week uplift in the portfolio. S&P is sitting at about 6.56%, and actually for the S&P 500 specifically, for me, I think in 2020 I'm definitely going to re-strategize a lot of my portfolio, and one of the key things will be my treatment of the S&P 500. I bought the S&P 500 not when I started investing, but probably like halfway through, and I saw it more as a retirement fund, which I still do. It's still my retirement fund, but I think I've underfunded it. When I look at how much I've allocated to the S&P 500 compared to how much I've allocated in Aviva, it's like, it's a third of the allocation. And I think, to be honest, I should be putting more money into some of these long-term opportunities that I think will just naturally, they'll have highs and lows. There'll always be highs and lows, but I think we'll just naturally have a long trajectory upwards when we're talking about the next 10, 20, 15, 20, 25, 30 odd years. Obviously I want to retire as soon as possible, so that's really important to me, so I should really be trying to think about that. So I'm starting to plan for 2020. I always tell you guys, you need to plan and have at least the next quarter, the next 6 months maybe even the next year plan, because if you don't have goals and you don't have plans set out, then you're just going to be very, very reactive to situations, and I don't think that's a very good place to be in when you're investing. You need to try and plan what you're going to do, and if you are wrong, that's fine. At least you know why you were wrong, and hopefully you can adjust your strategy, adjust your plans going forward. So that's pretty much what I'm going to do regarding the S&P 500. I also wanted to talk to you guys about India, and I don't have anything India related on my screen, so I'm just going to put the emerging markets, as I'm going to talk about that straight afterwards. But India's been sliding into America's DMs. Like, when a girl posts her breakup on Instagram, right? Like, she's like, oh, me and Chad, I thought he was somebody else. After 5 years, he wrecked it. Like, and she posts up how much she hates Chad and that, like, on her Instagram. And then you've got all of those boys that have been just camping outside, waiting for their moment to slide into Tiffany's DMs, like just put their CV into the mix. That's what India has been doing. India has been trying to slide into America's DMs, and it's really funny actually. And I think, to be honest, they're doing what they need to be doing for their economy. So pretty much, basically, the situation reads as this. And I'm taking this from The Guardian. India's targeting US companies amid China trade war. So because obviously there's a lot of issues with China and USA at the moment, India is seeing this as an opportunity to potentially slide into America's DMs and steal some business. So Reuters has an interesting exclusive. They've heard that India is hoping to woo foreign companies such as Apple to encourage them to move their operations from China to avoid the trade war. India is targeting companies including Apple, Foxconn and Winstone Corp with a charm offensive aimed at encouraging them to shift business out of the trade war hit China, according to a source and a document seen by Reuters. Several Indian officials met on August the 14th and discussed a list of target companies that also include Taiwan headquartered contract manufacturer Pegatron Corp. A source with direct knowledge said the dispute between the United States and China, the world's two largest economies, has led to higher tariffs on goods worth billions of dollars and disrupted global supply chains, prompting companies to look at other investment avenues to escape higher tariffs. Amid suggestions that India is late to capitalize on the trade war, government ministries have been asked to submit their policies and incentive structures to invest India, the country's foreign investment promotion agency. 9 sectors including electronics, autos, pharmaceuticals and telecoms will be targeted. Now, what this basically means, in short, just to summarize, is that obviously a lot of things are manufactured in China. The trade war has had a global economic impact. So, with the tariffs being hit on China, it means China might raise prices. If China raises prices, all of the companies that rely on China for manufacturing potentially will have, less consumer revenue, consumer demand, because potentially those additional costs will be passed on to onto consumers, and that's the reason why markets have been declining. So that's generally the trade war cycle, and what India is basically trying to do is see this as an economic opportunity for their country to try and get some of the business away from China, probably to accept the tariffs at whatever the rate that America is willing to charge, and maybe even pay more in tariffs from that standpoint, in order to win the business, and therefore take some really, really big contracts, which will have a very, very good impact on India's economy. I assume it would have a good impact. I can't speculate. This is just one side of the story. I assume it will have a better impact on India's economy, which is probably the fastest growing economy in the world and has been for quite some time, and probably going to be one of the world's superpowers in the future. And so that's what they're effectively doing. They're sliding into DMs and trying to just, steal America's heart. So, I think it's a good thing for India. But what I really wanted to talk about is how, that impacts from an emerging market standpoint. And are emerging market investments a good investment in a pending recession? There's been a lot of talk that a lot of people are selling off or holding or not buying EM funds or EM stocks, during a recession, during a global crisis, etc. And as you can see, there's quite a few EM opportunities at the moment sitting on free trade at the moment. However, I reposted on the gram something from Bloomberg, which is a JP Morgan trader who's beat like 90%, 98% actually of traders of her peers, says it's a good buy and valuation suggests decent returns in the next 12 months. Her track record and credibility in JP Morgan is up there. It's very, very up there, to be honest. And so for those of you, willing to risk it for a chocolate biscuit, I think emerging markets actually might be worth a punt. That's my personal take. Obviously, you guys need to do your own research, but I don't believe that it's any worse having an emerging markets fund than it is having a UK fund or a US fund in a recession. One, because it's also dependent on where the recession's hit and where it's impacted, and two, if prices are deflated and it's nothing to do with the actual fundamentals, then as valuations might suggest, it is a potential buying opportunity, which we talk about all of the time. So it depends obviously how big the drop could be and how the magnitude of it. Obviously there's so many other factors to consider, but I don't think naturally you could say recession, go away from emerging markets. I don't think it's as easy as that personally, and some people are actually saying that potentially there's a good return to be had. So me personally, I'm willing to risk it for a chocolate biscuit. I'm willing to risk it all. If it means me loading up now to end 2020 in a decent place, then I'll do it, because I'm a very, very sort of futuristic thinker. Not futuristic, but I sort of think more where I want to be in the future, as opposed to worrying too much about today. So that is something that I might potentially definitely look into. And yeah, it might be worth a punt. An example of this actually is if we go to sentiment. So do you remember many moons ago when sentiment was sitting at 0.9p, and you can see just above where it says 1M on this chart, you can see where it was nestling at 0.84, 0.91p, and it wasn't considered a buying opportunity. We was all crying, we was all selling, not me personally, but some of us were selling, and I personally was so risk averse at that time, and I just held. I did some small injections of capital. I did my regular dollar cost averaging, but I never sort of went gun ho and sort of loaded up and saw it as a buying opportunity. And if I did, I'd be absolutely laughing now. I'm up 36%, this time round, and it'd probably be a lot more had I seen that a depressed market or a depressed stock at a certain time can be such a great opportunity. So I'm always on the lookout for buying opportunities, and I'm almost more excited when stocks are down than when they're up, just because of what potentially could happen in the future. So I'm just thinking, how much worse would it be if the buying opportunity was for a whole year, and a year later you look back and think, I should have done it. This is obviously just a couple of months, this situation, but if it was for like a whole year, then you've had a whole year to potentially make some money, and you might not have done it. Anyway, I'm just talking about me. You guys have to assess your own risk tolerance and your own risk level. So in terms of the good, the bad, the ugly, S&P 500 is definitely within the good. I would say within the bad is definitely the insurance stocks. Now, they've had great earnings reports, particularly Legal and General. You can go back on my previous videos. Their earnings has been phenomenal, but obviously because of the market conditions, it's just still a bad place for insurance at the moment. So yeah, they're definitely within the bad part of it. But because their fundamentals are strong, I'll just keep buying like I should have done for sentiment. The ugly, however, is definitely the banking stocks such as CYBG, Lloyds and Barclays. But we already knew this. However, I do see some market positivity, and this is what I wanted to talk to you guys about. I do see some light at the end of the tunnel. The PPI deadline was the 29th of August. Banks had to set aside cash to allow consumers to be able to claim, on their PPI. For those of you that don't know what PPI, just remember those adverts that would come on, like when you're watching Jeremy Kyle or whatever, my sister, slept with my brother or whatever it is, and then it'll go to an advert, and then you would hear Gladstone Brooks, like those adverts, those PPI adverts that will just come on in the mornings. Like that is what the PPI situation basically is. Payment protection insurance. Many moons ago, unscrupulous bankers like myself would basically sell to you guys payment protection insurance, but it'll be missold, so you wouldn't even know that you bought it, you wouldn't even know that you had it. The good old government came in and said, this is wrong, you guys need to stop. But not only do you need to stop, you need to pay back every single person that you did it to for the last like 20 years or whatever, or maybe even longer actually. So actually, people have had years. They've had absolute years to claim on this PPI. I think it's been about 13 years, maybe 10 to 13 years since it was passed that banks need to honor every single PPI claim, which is the reason why all of these law firms started, producing their adverts so that they could take some of the claim money and do all of the work for you. And I don't know why I got Robo Global on my screen. That was a mistake. And basically, people have had absolute years, but procrastination is like the biggest flaw of human nature, to be honest. And now what we've seen recently is Santander's systems have been crashed, and loads of other bank systems just haven't been able to cope with the amount of demand over the last couple of days. Like you lot didn't have 10 years to claim. It's crazy. Anyway, that's my consumer rant. But for investors like you, which is all I really care about, is the good thing about it is that now it's officially over from a banking standpoint, which is all I care about. What that basically means is that maybe there might be a few more, like 1 or 2 claims that are just still being processed, but ultimately the deadline has passed. The 29th of August has passed, and if you missed your PPI payment, then you've missed it. And so that means now banks can start re-ingesting their capital into actually potentially giving better products and services, etc., so that they can actually grow their revenue and grow their books. We saw in Lloyd's earnings, I think they were up 2.9 billion, but because of the money they had to set aside for PPI, you see that tank that you can kind of just see there. I don't know if it's clear in the year graph. Yeah, that right towards the end of this graph, you can kind of see that big drop. That's all to do with the fact that the news headlines was PPI share price. Sorry, they have to set aside money for PPI, and the share price tanked. And this is the age-old narrative of sentiment over sense, to be honest. I mean, the bank was profitable. You expect it to rise. Headlines read you got to pay some change in PPI, and it's changed compared to what they've got on their books, and then the shares decide to fall. So hopefully, and again, this is just my assumption, but hopefully we are nestling at the bottom of this from a banking perspective. Hopefully we'll see some uplift. And the only real major factors to affect banks at the moment, aside of their fundamentals, is Brexit and GDP negative growth, aka recession. Now, I'm going to be holding. I'm not going to go gun-ho with this, just because the other 2 factors being Brexit and GDP negative growth are going to be absolutely significant factors, but at least one thing has been ticked off. The PPI situation has been ticked off, so hopefully we might start to see a bit of an uplift. And I would just put normal small injections of capital every now and then, no big allocations, as there's still uncertainty, but I do think there is light at the end of the tunnel, and I wanted obviously to give some positive sentiment out there that hopefully you guys should see some increase. This is just my personal assumptions. Now I want to talk to you about the 8 pending stocks. So as you guys know, I do a high level analysis of free trade stocks every week when they release their new 25 stocks and their ETFs. If you don't, check it out. There's been a few things that they've been releasing, and there was 8 stocks and ETFs that I've put into what I call a pending status, which means that it's past my high level sniff test, so to speak. But now I'm going to look into them a little bit more further and decide which one of them I'm going to potentially buy. So the one of them being Investec, which I'm just going to put on your screen so you guys know, just in case you can't understand my accent or anything like that. The other one, you won't be able to see it here because it's not in the ISA. It's called British Land. It's a REIT. I'm obviously going to have to do that in my basic account. Landsec, another REIT, which I'll have to do in my basic account. Greencoat, which is a fund that's about renewable energy, similar to Trig. I think it's predominantly focusing on the UK and a few other places, but yeah, Greencoat was a potential. I was also looking at Bluefield, which is, they need to get more creative with their name. Greencoat, Bluefield. Anyway, Bluefield, I can't even type. Bluefield, another sort of green fund, another sort of green stock. that I was potentially looking at as well. Don't know why it's not loading, so I'm just going to skip that. I was also looking at Page Group, which I spoke about yesterday, so go check out the video yesterday. Page Group was definitely, I saw as a potential opportunity. And then also the JP Morgan Emerging Markets Bond, which is SEMB, the one I'm showing to you right now, the one that's sitting there at the top, and also the Gold Producers ETF, which is SPGP as well. For whatever reason, they're not actually loading the information or data. Maybe it's a free trade issue, maybe it's me, who knows. However, some of these they look quite interesting to me, so I just wanted to just give you a roundup, just in case you haven't seen those videos and you don't want to go see those videos. I thought, let me just tell you here anyway. So what that basically means, I'm looking at these now, and in my next round of investing, which is actually due, my next round of investing has been due, but of late I've had my own little fiscal GDP decline myself. I had some fiscal challenges, so I've had to postpone it a couple of days. But hopefully in the next couple of days I will do my next round of investing. Everything will recover, and I can begin allocating capital either towards my current portfolio here, or towards some of those new bad boys that you currently that I just showed you a minute ago as well. So we shall see. And next week you should definitely see the ones I've chosen to be in my portfolio. You should see hopefully a comprehensive rationale as to why I've chosen those individual stocks. Obviously those are just 8 from the 75, the 80, 90 stocks and ETFs that have been released to date. And so, only 10% of them I saw some value in. So hopefully, it's clear that I've got a specific criteria. I'm not just going to buy anything. And, I can be able to explain that to you guys next week in the next portfolio update. ISA allowance has been fixed, so now it shows my accurate ISA allowance availability. So I've got 12,486 remaining up until April the 5th, 2020, which is good. Will I hit it? Well, I don't really know. I'm not too sure. We'll see, hopefully. But it all depends what happens over the next few months, and how much I want to risk investing versus just saving up in cash, because I do think saving up in cash is very, very wise in this current climate as well. Anyway, I wanted just to let you know that I think there is some positivity coming in the market, particularly around the PPI stuff with the banking situation. Trade war seems like maybe there's a bit of positivity there as well. Also, next month, being September, I'm going to be getting all of my dividend payments. So I will let you know how much I should be expecting in dividend payments, because obviously there's been a lot of ex-dividend dates this month as well. And so, hopefully next month should be a really good month in terms of dividends as well. So that's some more positivity. So yeah, I'm here to spread some positivity in the midst of everything that is going on. But hopefully you found this video useful and insightful. If you've got any questions, if anything wasn't clear, please get in the comments, and obviously I'll do my best to respond as quickly as I possibly can. Other than that, please like, please comment, please subscribe, and I will catch you next time with another investment video. Peace.